My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Welcome back. Today our special guest is a very experienced entrepreneur and real estate entrepreneur. Paul Moore is zooming in from Virginia, and Paul has a very interesting background. He's one of those smart guys that was an engineer, then he got an MBA, then he worked for Ford Motor Company, then he got bored with that, started his own business, I believe in the staffing field. Must have done something right there because he sold it to a private equity company, cashed out pretty big in his early 30s, I believe, retired for a while, probably got bored with that, and then got into real estate investing, doing all sorts of different things. And for the last almost 15 years, Paul has really been focused on, getting into not so much the commercial side of things and raising a lot of capital for that. So his company is Wellings Capital. And Mr. Paul Moore, welcome to the show. Great to have you.
Great to be here, Dave. Thanks.
So, Paul, let's zoom out. Give us a little snapshot in the middle of 2025, which is where we are right now. What do you guys invest in, and what does the portfolio currently look like?
Well, I was trying to be a multifamily. I guess you could say I was a failed multifamily syndicator. We, in the mid to late teens, were trying to invest in multifamily, and it got so overheated, and there were so many people bidding prices up and using risky floating rate debt that we finally opted out. And we said, as an investor, what am I looking for? I'm looking for deep dive due diligence, and I'm looking for broad diversification. And it's really hard to get that by being an operator. So we decided not to be an operator. We started creating funds where we would create our own JV deals and pref equity deals with sponsors. We would handpick the best sponsors we could find in 6 different recession-resistant asset types. And we would structure deals with them, bring them capital. We've raised almost $200 million. We have 8 different funds. 2 of them are active right now. We invest in self-storage, mobile home parks, RV parks, multifamily, commercial retail, and light industrial. So that's kind of a quick snapshot of what we do, Dave.
That's a very good snapshot. So 2 big things that I think you guys focus on. One is vetting potential partners, sponsors, and the other one is raising capital. Would that be fair to say?
Yeah, that's exactly right.
Yeah. Okay, cool. And you're across multiple different kind of asset classes. You mentioned that you're focusing on 8 different recession-resistant asset classes. I know there's nothing exactly that's recession-proof, although some of these are pretty close. What would you say these days is your favorite asset class in real estate?
Dave, there is a massive affordable housing crisis. Yeah. And it's getting worse. It's going to get much worse, I think, in the next decade. Mobile home parks are the only asset type we know of that has a decreasing supply and an increasing demand every year. 10,000 people turn 65 today, but 6,000 of those 10,000 don't have 10,000 US dollars saved for retirement. And so, but a lot of them have home equity. A lot of them are willing to trade their home for a mobile home, and they can live at a fraction of the cost. They can have their own parking spaces, deck, backyard, don't have to share a wall with another tenant, and they can own their own home. And so mobile home parks are a great asset type that we think, they're not, it's no joke to say they're not building any more of them. I've heard you can count on one hand the number that are built every year in the US, yet the number that are demolished or just, they're just shut down every year is much, much higher than that. So we really think mobile home parks are a fantastic place to be right now.
What's your take on why that is, Paul? Why was this such a boom. I think it was in the 40s and the
Yeah,
50s and the
50s.
60s, building these suckers out. And, it seemed to be a panacea at the time. It seems like well, like you mentioned, there's huge demand for it right now. Why are they getting shut down? Why aren't more of these getting built?
Yeah, I mean, I wholesaled one in Fairbanks, Alaska, and I went around and did I looked at three or four competitors, and I think two had already been shut down because the septic systems were broken. It would have cost a massive amount of money to fix them. The homes were from the 70s. That's kind of rare that they're all from the 70s, but that was absolutely true in this case for
Hmm.
unique reasons in Fairbanks. But sometimes the homes they're smaller parks. The septic goes bad, the water system goes bad, the owner gets old and tired, nobody buys it. And a big reason, Dave, they're not being developed is called NIMBYism. NIMBYism means not in my backyard. People are always, these city council people are talking about needing affordable housing. But when the time comes for them to approve a mobile home park near the edge of town, they don't want it. It doesn't add much at all to the property tax base, but it adds to the drain on the school systems, the utilities, transportation, and frankly, people with $400,000 homes don't want a mobile home park a quarter mile away for lots of reasons that are sometimes unfair. But
Yeah.
that's just how it is.
So looking back historically, which I have not, but what's your take on why there was such a boom and what created that environment for a boom of mobile home parks 50 years ago?
I don't actually know. I do know that there was a boom in the 50s and 60s. In fact, Elvis reports that he had more fun, enjoyed his time more at his mobile home near Memphis, Tennessee, than he did at
Then in Graceland.
Graceland. And apparently, they had big parties over there. They had friends. They got mobile homes. They'd sit around a campfire, had a lot of fun. It was just kind of one of those things to do back in the 50s and 60s, from what I understand. Life was simpler back then. I mean, we all know that homes that were built back then often had, three bedrooms, one small bathroom, maybe even two bedrooms, one bath, and no basement. And they were a lot simpler and smaller. And, for a fraction of that, they could buy a mobile home
Yeah.
rather than a stick-built home. And I think for a while, until things went south, with them, I think that, there was not really a stigma. And then there was one later as, let's say, lower income segments of society moved there and they became kind of the last stop before living under a bridge for a lot of people.
Yeah.
And they got run down and they were poorly run
So kind of
and
like a rural ghetto kind of thing.
rural ghetto. Yeah, a place
Mhm.
that people didn't want to live. When I was a kid, my mom told me not to go anywhere near them. And I wish I wish my parents would have been smart enough to invest in them, but apparently only Sam Zell mainly was starting in the 60s. He acquired 157,000 mobile home park pads before he died a
Wow.
few years ago and made a fortune doing this.
Yeah, no, it makes a lot of sense. All right, mobile home parks, that's your favorite at the moment. Makes a ton of sense. Now, the other side of the business is raising capital, and you said you've raised close to $200 million. That's huge. Congratulations, Paul.
Thanks.
What, when did you first start raising capital?
Well, I actually went through a mentoring program with a multifamily company, and they taught us to get a broad database of potential investors. So when we had a deal, we could go out to hundreds or a few thousand of them and show them the deal, et cetera, et cetera. And I just stubbornly believed I didn't need to do that. I was above that. So I found a guy in China who said he had two billionaire friends, and
Uh-huh.
whenever I had a deal, just bring it to him. So I refused stubbornly for a year and a half or two to do that. And then, for time's sake, I won't tell you the details, but the two deals I took to him, one was too small, and the other one, it was Chinese New Year. How could I take him a deal during Chinese New Year, right? And so I finally went with my head between my legs back to my mentor on a call with other people. He said, "Do not ever call me again until you've done what I said." And I sheepishly hung up, embarrassed. And starting that very day, I started building a list of potential investors. I did that by writing a book. I was just about to publish a book that month anyway. I published the book, and I used that book to get on hundreds of podcasts. I
Ah,
used that book to become a blogger on Bigger Pockets. I used that book to get a show on Bigger Pockets, which was on their Instagram and Facebook live channel. It wasn't one of their big shows, but a small show I did weekly for years. I used that book to get guest spots at webinars and live events, and all of that snowballed. I had my own podcast as well. All that snowballed, and we had hundreds of prospective investors come in, and eventually thousands of prospective investors come in through all those mediums.
very cool. Well, that makes a lot of sense. And how many people, how many active and past investors do you have that have cumulatively put in that close to $200 million so far?
Yeah, last I counted, we had 995 investors currently active. The average first-time investor with Wellings Capital is $85,000. The average total investment after reinvestments, you can do the math, it's something like 195,000. 73% of our investors in 2024 were repeat investors.
Oh, that is fantastic. And it sounds like you got out of the whole multifamily syndication space at a good point. You didn't go through the upheaval and whatnot that's been hitting that industry over the last couple of years. You know,
Yeah.
kind of looking at it from your perspective, what's your take on the whole multifamily space?
Well, I was surprised it kept the ball, they kept the ball in the air as long as they did. In fall of 2017, there were already cracks in the ice. And in fact, November of 2017, some of the statistics said that it was over the top and going down. And then December 23rd, 2017 came along, and Trump and Congress passed the new, the Tax Act that allowed massive acceleration of depreciation. And all of a sudden, multifamily took off again. And of course, we all know that it's started to implode in March of 2022 with the first of 11 interest rate hikes. And that, of course, what didn't cause the problem, it only exposed the problem. Warren Buffett said, sure, there's a rising tide that lifts all boats, but someday that tide will go out and we'll see who's skinny dipping. And we sure did.
Yeah, a lot of people buck naked these days, that's for sure.
Yeah.
Yeah, so yeah, it was yeah, good, very, very good points there. Okay, now you ignored your mentor's advice initially. You tried to go for the whales. That didn't work. You wrote the book, smart, and then you leveraged the heck out of that. Um, I would imagine at this point, now that you've had, you've got 1,000 active investors and probably a whole bunch that have invested in the past. What are you finding's working best these days for keep because you've got funds and you're constantly raising capital for bringing on fresh new investors?
Um, I think just continue to do what we're doing, being a podcast guest. I've got 3 books in the works. I'm embarrassed to say that I haven't gotten across the finish line with any of those. If you have any advice, let me know. I self-published my first 2 books, including the multifamily one I referenced, and then I had Bigger Pockets publish the third. I'm
Mm.
not sure what to do next. I'm kind of trying to figure that out. We've actually poked around trying to get family offices, and our experience, along with almost everybody else I know, is that it's extremely hard to get family offices on board. And it's sort of hit and miss, needle in the haystack stuff, hard to do it systematically. We've also poked around trying to get registered investment advisors, and we've got 2 or 3, as well as 2 or 3 family offices. out of our almost 1,000 investors. But honestly, that's been hit or miss as well. We're not sure what to do next. We're kind of open to going with a broker dealer and paying them a fee to bring RIAs and other large investors to us. I think that'll probably be our next step.
Yeah, that makes a lot of sense. So looking ahead to the next 12 to 18 months, what's on the horizon for you guys, Paul?
Well, we just 8 days ago opened a new evergreen income fund. We expect to have that open indefinitely. It's no drama or low drama, hopefully. Um, Fairly predictable income producing with a little bit of appreciation. Be using pref equity a lot. And I'm not talking about rescue capital. I'm talking about middle of the capital stack for acquisitions and refinancing. And then we also opened a growth fund, which will probably last 2.5 years for raising capital, 10 years total investment term. And we're hoping to get, low distributions, but high total returns on that, mostly through capital appreciation.
Yeah, very good. That sounds exciting. So I would imagine that to keep this volume of deal flow going and to have something for these funds to invest in, you must be looking at a ton of deals, a ton of sponsors, a ton of opportunities. What does that kind of volume look like between what comes in the top of the funnel and what you guys actually end up investing in?
Yeah, last year we looked at 745 operators and deals. And I think 35 made it to the final round, and we invested in five. So less than 1% of what we looked at. We have a 27-point due diligence process. The problem, Dave, is the more we learn, the harder it is to get a deal across the finish line. For example, a year and a half ago, we weren't doing net operating income audits. Now we are. That's
Mm.
another layer, another hurdle for the deal to jump, to make it get it across the finish line. It's another, nine, $10,000 expense that we incur. The investors don't pay a penny of that. And that expense, again, it's another reason to say no. Our goal is to say no to every deal unless it can somehow prove itself to us that it should be a yes. And we've grown our investments team from really just my partner and I for years. We added one guy 3 years ago. Now we've added four on the team, and still so hard to get a deal across the finish line.
Yeah, that must be frustrating, but it also points to how persnickety you guys are,
Yeah,
which I would imagine is part of the reason why you've had so much success with your investors, why they've been reinvested so much. You're just very, very picky about the kind of deals that you
yeah.
get involved in. Do you see that getting easier or just consistently getting harder and harder as you move ahead?
I think one thing that's made it easier is we went from doing straight pref equity, which looked something like this, like a 9%, even a 10% current pay, which was debt-like, plus an additional, say, 6 or 7% compounding and accruing upside that, paid off to us when the deal was refinanced or sold. We went from that, which was very hard to swallow for good operators, as you can imagine, to JV hybrid equity, which is hybrid, if you will, between pref equity and common equity. It's a little bit up the capital stack. For time's sake, I'll just tell you that those type of deals don't have a current pay, but we are in a favored position when the asset sells. And because of that, it's opening up the door for us to get a lot more traction with great sponsors who don't have
Mm.
to have, that 10% current pay in their stack.
Okay, I can see that making a huge difference. So you can still be super picky about how the deal's working, what the property's like, what the cash flow is going to be, the net operating income, but you could be a little bit more flexible on how you're getting paid out. So
Yeah.
that broadens the scope. And I would imagine, like, once you find a really good operator that you've done a deal or two with and they've lived up to their end of the bargain, that kind of gives them a shortcut to more funding, I would imagine.
It is absolutely true. I mean, we had an operator who we love who came to us for $4 million 6 weeks ago, and we were able to get it approved in a week. The NOI audit took a month. Once that was done, we were able to close and get them their $4 million. And since then, they've come to us for another five.
Nice, nice.
Yeah.
Well, Paul, thank you very much for sharing some of your insights today. This has been great. I'm sure there's going to be a lot of people wanting to find out more about you and the company and perhaps connect. Where should they go?
Go to Wellings Capital. That's Wellings, wellingscapital.com/resources. And that'll get them a free ebook on mobile home park investing, self-storage, and more.
Fantastic. Paul, thanks so much. This has been a lot of fun.
Been great to be here, Dave. Thanks.
All right, everybody, take care. We'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.